Hello and welcome to part 3 of the Trader course with FOREX.com. This is our third installment in this 6-part series, and today we will expand on our discussion of technical analysis to investigate a field of study known as price action. Your host, James Stanley, will be on the line momentarily to introduce the topic and walk you through today's discussion. Before we do that, we need to look at a risk disclaimer, which will remain on the screen for 60 seconds before we proceed. Thank you for your time in advance, and happy trading.
Hello, welcome to part 3 of the Traders course. My name is James Stanley, and I'm going to walk you through today's discussion on price action. Price action is a massive field of study, and there's a lot to cover in this session. At its core, price action is the study of price without relying on any indicators. This is usually done with candlestick charting, although line charts can also apply. For this topic, we're going to focus on candlesticks, as this is a popular mechanism of incorporating this analysis. Candlesticks have a Japanese origin, and as such, there are some naming conventions derived from the Japanese language, and we'll cover some of those today. Perhaps one of the more widespread uses of price action, even by traders incorporating other analytical methods, is using candlesticks or price action to denote trend, or support and resistance. Candlestick is just a representation of price, after all. And if prices are making a fresh high, that's possibly notable. And that's something that the trader can glean directly from the chart. Timeframes present a number of questions to traders, and the question often comes up, what's the best time frame? Since we're using charts and candlesticks to support decisions, timeframes have become a very important topic in the field of price action. We'll address that topic here, but we're going to discuss this with balance. So to foreshadow, there will be no single best time frame. Support and resistance are pretty important to market participants, and price action can help to see that in action. And again, candlesticks are merely a representation of price, so a support or resistance level derived from a candlestick is something that actually traded in the market, and that is notable. We're also going to begin looking at psychological levels, which are prices at even, round, whole numbers. These levels can come in to offer support and or resistance, and we're going to look at how we can use price action to confirm that. We're also going to look at using actual highs and lows to pick on levels that may be impactful as support and resistance. As we've noted numerous times in the prior 2 sessions, risk management is of extreme importance. Well, price action can help with that too, and we're going to discuss that topic in depth in this presentation. Formations are another aspect of price action, as a candlestick or a collection of candlesticks may be delivering a message of some sort. And from that, the trader can generate some type of strategy in order to incorporate that message into their approach. There are numerous possible candlestick formations, but we're going to cover some of the more popular items here, like engulfing formations or hammers, morning stars, and wedges. And yes, this is a price action discussion, but reasonably, some traders will still use indicators, especially a common one like the 200-day moving average. We're going to look at how a trader can use price action with the 200-day moving average, and this could potentially be extrapolated to other indicators, depending on the approach. Before we get into today's discussion, I wanted to recap how we got here. In our first installment, we talked about fundamental analysis, and we looked at how economic data and trends in macroeconomics can help to shape trends in markets. We're going to connect that discussion to today's discussion on price action by focusing on the dollar-yen scenario that we discussed in both parts 1 and part 2. In that second installment, we looked at technical analysis. We investigated how trends in markets can display on a price chart and how traders can use that context to come up with ideas for trading decisions or strategy. Today, we delve into the field of price action, which is often considered to be more of an intermediate to advanced field of study. But given that we want to build this as a risk-first type of course, including this content could be very important as it can help traders to see additional context in the market that may not be available through indicators or by analyzing fundamental data. In our next installment, we're going to put all of these pieces together in order to start focusing in on a trading strategy. And perhaps more to the point, trading strategy to address the various market conditions that may display. After that, we have an entire installment dedicated to risk management. And for our final topic, we're going to go down the path of trading psychology. The next 3 installments are especially important as it begins to shift the conversation from market dynamics and towards you and your approach, your strategy, your way of addressing the market. With that said, today's topic may be illuminating as we'll aim to take a bland price chart with no indicators, an effort of seeing trends and support and resistance or candlestick formations that can be usable towards the aim of incorporating a strategic approach towards markets. So let's get started. What is the best time frame? This is a popular question amongst many new traders, but best is a relative and subjective word, and there really isn't an accurate answer to that question. I think one important way of looking at time frames is the same as buying a house or a car. If you want to buy an asset, you're probably going to want to see it from multiple vantage points before making a decision. Because maybe the picture on the listing from the street looks like a nice house, but once you get inside, it's only a wooden frame with no drywall and holes in the floor. If you bought this just from the listing, you really could have used a second vantage point. And this speaks to the concept of using multiple time frames to make trading decisions. This can fast become paralysis by analysis though, because there are so many time frames available to traders and they can all have their own purpose. So trying to follow all major time frames can quickly become a trapdoor and confusing. Instead, balance amongst those time frames is often the best way forward. Longer time frames are slower and as such could be more fitting to grade trends or to note the market's mood or behavior. If there's a strong trend showing on the longer time frame, that could help traders with their bias when lining up trades on the shorter time frame. Think of this as trying to get the wind behind your sails so that the general trend can, hopefully, work for you rather than against you. Using our home buying analogy, the big picture view would be like looking at the real estate listing or perhaps driving by the front of the house to evaluate the curb appeal. An important step in the decision-making process, but by no means enough data to make an informed decision. Shorter time frames, on the other hand, are faster, and there's more opportunity. But generally speaking, there's less consistency per bar, as there are fewer trades or decisions being made for each individual candle. And this means a greater opportunity for noise. This would be similar to seeing pictures of the inside of the home, which help to offer even more data, but again, could possibly be misleading as it excludes the big picture variables that we saw in the longer time frame with more robust, albeit less detailed data. Statistical sampling generally holds true, where fewer samples or ticks per bar mean that there's less data in each individual candle, thereby increasing the potential for noise. The monthly chart, for instance, doesn't often get much attention from retail traders because it's so slow. There's only 1 bar per month, so there's just not a lot of action there. The weekly chart is sort of the same, although it is a bit more frequent. There's 1 bar per week, and the support and resistance levels from that weekly candle can be key, as they could be in the mind of market participants for the next week. The daily chart is often considered to be somewhat of a sweet spot from an analysis perspective, but again, I would not call this the best time frame because it's only a single vantage point. It is a bit more frequent than the weekly or monthly bars, but many retail traders will still ignore this, as it may not seem active enough for short-term trading opportunities. Once we get inside of the daily chart, we're talking about intraday, which means we may be introducing more noise into the equation. And once we get inside of an hourly, matters can get much faster, as there are 24 hourly bars for every day and 120 for every week. And setting up trades from a 5 or a 15-minute chart could be a very volatile endeavor, just because there's so much less of a sample size in each individual candle than what the daily or weekly chart might offer. This isn't to say that analyzing markets and trading on short time frames is impossible, but the additional potential for noise, as produced by smaller sample sizes, is something that should be incorporated by traders choosing to take this ultra short-term type of approach. Multiple time frame analysis can be the answer to the perspective problem, as it can allow traders to focus on a smaller number of time frames in effort of coming up with trading decisions. This would be striving to strike that balance when deciding on whether to purchase or sell an asset, similar to the investigation one would do when buying a home or a car. But the key here is ensuring that the time frames have some type of relation to one another, as using a 5 and 15-minute chart may not offer much clarity to the trader lining up positions on the daily or weekly chart. On the right side of this screen, I'm looking at some sample arrangements, and in each, the longer time frame would be used as the trend chart, helping to see the market's direction and trend, or possibly lack thereof. Shorter time frames offer more detail, and after the trader knows the direction that they want to trade or approach a market, they can then work on how they're going to enter, and that's where the shorter time frame comes in. So for the trader that's using the weekly chart for trend analysis, they could then use the daily chart to try to find their entries in consideration of those longer term trends. Or for the trader that's using the daily chart to analyze trends and market direction, they could look to the 4-hour chart for entry opportunities. For traders employing an intraday approach, the 4-hour chart could possibly be used to identify trends and notice market direction, at which point the trader could then utilize the hourly chart in effort of trying to pick entries. And for traders that wanted to look at an ultra short-term approach, they could look at using the hourly chart to grade trends or to diagnose market moods, then using the 15-minute chart to try to plot entry opportunities. Generally speaking, we're looking at a ratio of 1:4 to 1:6 for multiple time frame analysis setups, where the trend chart is between 4 to 6 times the length of the entry or the trigger chart. Price action is the study of the chart using only price and no indicators. This field of analysis is focused solely on price and related dynamics. By removing any other indicators or context from the chart, the trader can then focus in on how markets have reacted at various price levels in the past. And even a single candlestick can contain a plethora of information. But when considered cumulatively, a series of candlesticks can contain even more information, helping to identify support or resistance levels that have held through multiple periods. Noise is present in all technical analysis, and indicators bring the prospect of additional lag, as the prices that are registering on the screen now are usually going to be averaged with a series of past prices, like with the moving average of 200 periods. Well, this one single bar's value is only going to comprise 1/200th, or 0.5% of that indicator's value. For an uptrend to begin registering in that indicator, it will need to take place for some time before the 200 period moving average will reflect as such. Price action aims to address this lag by focusing solely on price, and the dynamics of even a single candlestick can deliver a number of important messages to traders. The high and low of the candle are fairly obvious from the high and low of that bar. This was the highest high and the lowest low that traded during that period. The candle body represents the net movement, and candles are commonly either red or blue. Red representing a net loss for that period, while blue represents a net gain over that period. Since this is a blue bar representing a net gain, the low of the candle's body would be the open price, and the top of the candle's body would be the close price. The wick is an important part of this discussion. The wick on either side of this candle body says that during this candle's formation, price had went down below the open price, and it also increased even higher than the close price before paring back that gain. The wick is an important thing, as it showed us a range of prices that were tested during this candle's formation that the market had rejected. Now, maybe this was something random, or perhaps this was a support and resistance level, but the wick of that candle can be a very important thing to the price action trader. The takeaway here is that candlesticks send messages, even if it seems inert or non-directional, as this candle does. But the collective build of a candlestick, its body, the proximity on the chart to other candlesticks, and what those other candlesticks at the time were doing, that can deliver a massive message to market participants. But first, let's go into a candle that delivers a message of indecision. The doji is a fairly common occurrence on the chart, and as you can see on the right, it's basically just a candle with no body. This candle shows a close price very near the open price, with the range of prices from that period displayed as wicks on either side of the body. Due to price closing very near where it had opened, this will often be considered as a form of indecision. In Japanese, doji translates from the same thing, which means the small body of the candle is highlighting that there was little change during that candle's formation. Indecision in and of itself may not be saying much, but when taken with other candles, or in certain situations, it could be delivering a message. We'll look at how this can come to fruition with a formation a little bit later. It's important not to read too much into a doji or a series of dojis on very short-term charts, such as the hourly or below. And the reason for this is the big picture. If we're waiting on a key rate decision or a release of inflation data, traders may be exercising caution ahead of that expected driver. Another way of looking at the doji is that prices displayed equilibrium during that period, as buyers and sellers were roughly offsetting, with neither wanting to make a trend side move in either direction. But again, context can be important here. If all of a sudden the market shows indecision after a really strong trend, that may be an early warning sign of change. The Marubozu is somewhat of the opposite of the doji. Marubozu translates to dominance in Japanese. This is a full-bodied candle that displays a noticeable move during that bar's formation. And speaking to that, this candlestick really does indicate a level of dominance in the trend during that period. This candlestick has little to no wick, indicating that the market opened at the top or the bottom and then finished on the other side, illustrating that dominating trend that ran during that candle's formation. This candle indicates a strong trend during the session, and again, this is almost the polar opposite of the doji formation, but it's alike in that a single candle can tell a story. But that story may be more powerful with context, as we also need to know what else has been happening that led to that candle's formation so that we can learn how to take this with context. Marubozu candles aren't as common as dojis, but these formations will often be approached with the aim of continuation when they do appear, driven by the premise that the trend was so strong during that bar's formation that it may continue on to the next bar. The engulfing formation isn't necessarily the same as the Marubozu, but it is similar in the fact that we have a dominating candle that's just made a very loud statement as that candle was being formed. The engulfing candlestick has to completely engulf the body of the candlestick before it. This signals a change in market behavior, as noted by the outsized move that happened during that bar's formation. The engulfing candlestick could signal a push of momentum, as markets produced a wide range of prices during that bar's formation. The engulf is often tracked for a continuation of that momentum, with a bullish engulf opening the door for themes of bullish continuation, while the bearish engulf opens the doors for themes of bearish continuation. This candlestick delivers a big message, and on this example, with a big red bearish engulf pattern showing after a sequence of strong bullish candles, that message is probably a negative for this market, or a bad thing for bulls that were long. On our next slide, we'll get more in depth with this example. We're now looking at the example from which the prior slide was derived, but with a bit more scope. On the left side of the chart, we can see a bullish trend running all the way until price prints a bearish engulfing candlestick. The engulf makes quite the statement, as that bar eclipsed the prior day entirely, and in this case, it actually eclipsed the entire week leading up to it. But the engulf is what helped to mark the top in this market. And this is dollar yen in Q4 of 2022, which we will be talking about quite a bit more through this presentation. For now, I want to focus on what happened and where it took place. As you can see, the 150 level on the right side of the chart and the engulfing candle had tested above that price before a very strong reversal took place. The day that the engulfing candle printed marked a change in trend, as buyers were unable to hold the test above the high point that marks the top of this candle. And while the aggressive selling didn't become obvious for another couple of weeks, bulls remained on defense after the candle had printed, with sellers eventually taking control of the trend to produce fresh lower lows and lower highs. While considerable focus is paid to candlestick bodies, the wick can tell a story all on its own. The wick highlights prices that were traded during that bar and ultimately were rejected during that bar's formation. This could be a reaction to a resistance level. If a period opens with strength and buyers are driving, and then bam, prices run into a large resistance level that elicits a reversal, and then sellers come into the picture to drive prices back down below the original entry price, then that failed bullish run that opened the period would be illustrated by the upper wick on a candle. An elongated wick highlights a larger reaction, and an elongated wick that printed after the test of a key level can be seen as a support or resistance reaction that may have taken place because of that level. This doesn't have to be from a single wick, however, as a series of wicks showing or printing at the same price or same level over multiple bars can further solidify that argument that support or resistance may be helping to pull new buyers into the equation. And if there's an inflection point on the chart where buyers are coming in to defend support, or where sellers were coming in to defend or sell resistance, that could lead into a swing or a bounce in the market. Could being the key word there, because again, the past does not predict the future. The entire point of this is to get an idea for how we can approach these types of situations when they do appear. But let's take it a step further with support and resistance. If one or two candles holding a level can deliver a message, then so can 4, 5, or 6. And more to the point, the way the candlesticks form could even be taken a step further as we begin to look at or incorporate formations. A sequence of candles lining up at one particular area can highlight a continued build of support at that level. Now, it's important to remember the other side of this. If a support level is continuously being tested, it's because sellers keep driving the price down there. But if support is holding, they've been unable to break down to a fresh low just yet. Once price begins to show evidence of reversing or bouncing from that level, we may have the early stages of a reversal that could possibly lead into a new trend. That may lead into a bullish response. Perhaps one of the more important aspects of this is in the ability to manage risk by inserting an if-then statement, saying, if support holds, then I can look for X as a possible reward. This can allow a trader to go into that setup, using their analysis, to implement a risk-reward ratio that they're attracted to. And if they don't think that an attractive risk-reward ratio would be possible, well, then that's a trade that they may not want to place, as the possible reward wouldn't be worth the risk that they had to take on. The swings produced by price action can become support or resistance all on their own. If price drives down to make a new low before bouncing, that low may become notable if it comes back into play later. Perhaps that price is also a support or resistance level from some other form of support or resistance analysis. But that matters less than the reality that this price has exhibited a tendency to stall the sell-off. Multiple periods or days of support at that level highlight a continued hold of support around that price. It may not be perfect, as intrabar tests show sellers trying to push price down to a new low, but are continually thwarted, as suggested by the underside wicks over that sequence of candles. If support has shown a tendency to hold, it may continue to do so. It also might not, but this highlights something that could potentially lead to a strong move. And the simple act that we know where support is can be enough to approach the setup with some idea of approximate risk-reward ratio potential. Many traders miss this about support or resistance, as they're often looking for ways to buy lows and sell highs. But the bigger takeaway is the support or resistance offer a spot to place a line in the sand, so that if support is broken, the trade can be exited with the goal of loss mitigation. But if support does hold, then the trader could potentially look for a reward that's larger than their risk outlay. This can lead to the situation where the trader can look for risk-reward ratios of 1 to 2, or perhaps even higher, under the premise of support or resistance holding. The past does not predict the future. I know that we've said this a few times already, but it's worth pointing out again, particularly on this topic of support and resistance. With price action, traders are not trying to predict. They're usually looking to react based on what's happened in the market. And for that, support and resistance identification can be vitally important. One key reason is the support and resistance may offer an inflection point that produces a change in the marketplace. May being the key word there. But the fact that traders can place a line in the sand can be helpful as they look to implement strategy, so that if that support does hold, then the trader's long position could work out. But if it doesn't, and if price breaks support, then the trader's stop can help to exit the position before that short-term trade becomes a long-term problem. A major aspect of support and resistance is possible implication for risk management. This is one of the ways that traders can use technical analysis with the aim of finding setups that may offer attractive risk-reward opportunity. Because if you enter a trade with the idea that price might move up, and that thesis is based on price holding support, and then support breaks, thereby invalidating your thesis, do you really want to stay in that long position, just hoping the price comes back? It's entirely up to you, but evidence of support breaking could further illustrate that the initial thesis was incorrect, and risk capital may be better deployed elsewhere in an idea that hasn't already failed. Price action does not have to be used in a vacuum. The 200-day moving average is a popular indicator, as we looked at in the last installment for technical analysis. Traders will often look to this indicator as a grade of trend, but it can be used with price action as well, since many traders in the marketplace are also following this indicator. If price moves up to the 200-day moving average, and even trades above it intraday, but then closes below it, we may have just seen a resistance inflection. That response could be from the 200-day moving average itself, from sellers coming in to react to the intraday test above that level, but we won't know for a fact that this reversal is happening as it's taking place. All that we know is that there was a response intraday, and it may have been because of the 200-day moving average. But more importantly, that reaction may continue. Again, it also might not. But the trader can look at placing a stop above the high from that day that the reaction took place. That way, if price does go back above the 200-day moving average and then breaks above that prior swing high, the trader can exit the short position with the aim of loss mitigation. Support and resistance is helpful in technical analysis, but again, its larger implication is for risk management, helping traders to place lines in the sand where their trades may be invalidated, where they know that they want to exit with the aim of loss mitigation, so that a short-term trade doesn't become a long-term problem. Psychological levels are simply even, rounded whole numbers. This would be like 110 in euro-dollar, or 120 or 115. This isn't just a market idea, and you've probably engaged with this in some form or fashion, as most retailers use a similar strategy. The price of 99 cents usually feels much cheaper than just 2 cents less than $1.01. Just seeing something cost more than $1 will have a tendency to make that thing seem or feel more expensive than something that's less than $1. And retailers use this strategy to try to get people to buy products, so making those products seem cheaper than $1 could be beneficial to their overall strategy. This is so widespread that even the purchase of an automobile or even a house could see this type of pricing strategy. The price of $99,999 feels a lot cheaper than just $2 less than $100,001. And this can bring impact on market behaviors, as human beings often operate as driven by crowd psychology. This can bring impact in markets too. In this example, we're looking at the parity value in Eurodollar when it came into the equation in the summer of 2022. At the time, the Eurodollar pair was in a hard bearish trend, falling by hundreds of pips in the month of June until finally coming into contact with a parity level at $1 even in July. There was even some testing below that level, as illustrated by the underside wick that showed on the chart. So this wasn't a smooth test, but buyers did bring the daily bar back above that level by the end of the day, highlighting a support response to the psychological level. And while it wasn't direct or automatic, that support inflection eventually ran into a bounce that lasted for a little over a month. Sellers did eventually push price back below parity, but not after a bounce that went on for more than 350 pips above that parity level. Psychological levels can often be sought out at even increments for every 100, 500, or 1,000 pips. So in Eurodollar, the $1 level at parity would qualify, as would the 110 or 90 levels. But traders can also take this to a more granular degree, looking for those levels at 100 pip increments, so $1.11, $1.12, $1.13, etc. We think of the convention of a Forex pair, where a Eurodollar quote is really saying the value of €1, or the base currency, in terms of USD, or the quote currency, is X, with X being the spot rate of the pair. It makes sense as to why even whole numbers may come in as important. Because for actual producers or hedgers looking to address currency exposure, they may not be looking for 4-digit pricing. They may instead be looking at the common pricing structure, which will usually be 2 digits beyond the decimal. We looked at the Doji to kick off this discussion, and that's basically just a candle that's displayed no discernible bias, and if anything, pure indecision, evidenced by the fact that price did not retain a significant higher low during that candle's formation. But this can also be seen as equilibrium, as the Doji highlights a market that was unable to make a fresh higher low as buyers and sellers had roughly offset each other. But the context with which that happens can be meaningful, especially if the market was showing a strong bias ahead of that indecision. In that case, a Doji printing would represent some element of change, as the strong bias that existed before is now showing indecision and possible equilibrium. Or, said otherwise, something may be shifting. If the market is showing a strong trend illustrated by a series of higher highs and higher lows, and then, all of a sudden, a Doji appears, traders need to take note, as that represents some element of change, which may possibly be a sign of more change on the horizon. At the very least, traders have failed to continue what was previously a strong trend. This would still be early stage, as all that we have is a sign of indecision, but this could lead to a candlestick formation that may become usable. The takeaway here, at this point, is that something may possibly be starting to shift, as noted by the indecision that's taken place after a discernible bias was priced into the market. If that Doji is then followed by a sell-off, we may have a formation to work with. An evening star is a 3-body formation that indicates a possible top in the market. The formation begins with a bullish trend that continued the prior trend. This is then followed by indecision, as shown by the Doji formation. And then the next candle would be a bearish candle that takes out at least half of the body of the first candlestick. If this 3-bar sequence prints there may be a topping formation to work with, as evening stars are often followed with the aim of bearish reversals, positing that a near-term top may be in place in the market. Taking the logic that we discussed on the previous slide, a strong bullish trend ran into indecision as the Doji printed on the second candle. This highlights buyers shying away as they were unable to continue the fresh high, and instead may mark an entrance of sellers that have begun to offset that buying pressure, helping to show equilibrium as presented by the Doji. If sellers can continue that theme by actually forcing a reversal of bar 1's strength on the third bar, that may be a sign that sellers are willing to take a stronger role in the matter. And the evening star will often be approached as if the market may have just made a top, ahead of a stronger possible show from bears. On this slide, we'll get more in depth with the formation. One caveat and point of emphasis: the evening star and shooting star are completely different formations. The evening star is a three-body formation, whereas the shooting star is a single candle formation, which we will look at a little later. The attraction of the evening star is that it's a three-bar sequence that shows possible topping over multiple periods. The first candlestick in the formation is bullish, continuing the prior trend of higher prices. This is then followed by the Doji, indicating indecision after that bullish move. The key for the formation is the third bar, showing a bearish reaction after the bullish bar led into indecision for bar 2. Bar 3 needs to close at least halfway below the body of candle 1, illustrating retracement of the previous bullish move. This can then be considered as possible topping of that previously bullish trend. This is usually approached with the aim of bearish reversals, and traders can look to place a stop above the top of the Doji, so that if the bearish reversal does not pan out and prices do jump back above the high that printed for the formation, the position can be exited with the aim of loss mitigation. That is perhaps one of the more attractive parts of the formation, as the trader knows relatively early that the topping formation that they were plotting around is not playing out if buyers are able to push through the highs. So the formation comes with some built-in risk management parameters, and if sellers can't continue to push for the trend reversal, the trader can prioritize loss mitigation. But if sellers can continue the reversal that was illustrated in that three-bar sequence, traders can potentially look for targets that are 2 or 3 times the size of the stop that was needed to be placed above the high of the formation. This is a picture-perfect example of an evening star playing out, and this is pretty much best case scenario. On the left side of the chart, we can see a bullish trend continuing to push higher prices as the trend displayed continuation of both higher highs and higher lows. The formation appears after a prolonged bullish move, noted by the three-bar sequence of bar 1 showing continuation, bar 2 showing indecision as noted by the Doji, and then bar 3 showing a reversal of bar 1's strength. Again, that third bar needs to close at least halfway below the body of candle 1, but in this case, it closed below the entire body of candle 1, thereby illustrating an even greater pull from bears as they reacted after the indecision that was displayed on candle 2. The bearish trend then continues to run for a prolonged period of time. And again, that's what makes this a picture-perfect example of an evening star playing out, as the trend reversed at the very top of the move, marked by indecision as noted by the Doji. We looked at a picture-perfect example of an evening star on our last slide, but as remarked, what made that formation successful was what happened in the follow-through of price action. And if we're looking at daily or weekly charts, that could be a lot of time, and that's a lot of opportunity for change. Another evening star appears towards the right side of our chart. But as opposed to the market continuing the bearish momentum after the third candle's formation, the first candle after that formation completed was a bullish bar. This was followed by another Doji and another bearish bar, which then led to 4 consecutive red bars. But sellers were unable to break price down to a fresh low, with buying support showing up before sellers could push price to that fresh low. And after bears failed to push through the low, then prices started to reverse. So in the second example, the formation did not lead to a big picture bearish trend as the first one did. One major difference is what led into the formation. In the first example, price was trending higher a long time before the bearish reversal formation had printed, while the second evening star was basically produced after a bounce from the lows after that prolonged bearish run. This makes it easy to see with hindsight, but when you're setting these formations up in real time, you won't know that price had just made a significant low, which is why it's important to look at examples that aren't picture perfect so that you can get clarity on how they should be approached. And this is an important point of price action because, again, we're not trying to predict the future by looking at the past. We're trying to incorporate the context of what's happening in effort of looking at setups that may possibly move in the direction that we want. The aim here is to react to what the market is actually doing, rather than predict what we think or hope that it might do. The exact opposite of the evening star is its bullish counterpart, and this is the morning star formation. Morning star formations are 3-bar sequences as well. A bearish bar begins the sequence, indicating sell-off or weakness in the market. A doji prints after that, highlighting indecision after the bearish move. A bullish bar prints after that, which then takes out at least half of the body of the first candle. This is the exact opposite of the evening star, and as such, this formation is often approached with the aim of bullish reversals. The allure here is that if the low is broken, the formation is invalidated, so this becomes a way that a trader can look to trade a bullish reversal with a very clear area to invalidate the formation if and when it's broken. This is an ideal case for a Morningstar reversal pattern. The market is heavily selling off until the 3-bar sequence appears, noted by the bearish impulse candle that continues the trend, running into the doji, which highlights indecision, illustrating a pause in that trend. The 3rd bar of the sequence retraces more than half of the 1st bar, thereby confirming the Morningstar formation, after which price continues in a bullish trajectory, eventually wiping out the bulk of that prior sell-off. Formations can be helpful to traders because they show something that may happen, and perhaps more importantly, the very logic of that may happen also includes risk management parameters. Because if a low price comes into play, does the trader really want to hang around in a bullish reversal setup, hoping that they may eventually be right? But price action is much more than just formations, as traders can also use price action to grade and trade trends. Trending market environments can be a favorite of traders for a number of reasons, key of which is the possible biasing effect that can assist with strategy implementation. In our section on technical analysis, we looked at a few different ways of grading trends with moving averages. But really, you don't need a moving average to notice a trend. Bullish trends will often display via price action as a series of higher highs and higher lows. Or conversely, for downtrends, that will often show via a series of lower lows and lower highs. There's usually a reason or explanation behind the trend, and that can often have some root in the fundamental analysis of that market environment. We looked at dollar-yen a few times in this installment, and we'll look at it again. But as we discussed in the first part of the course on fundamental analysis, there was a very big reason for that bullish trend in dollar-yen in 2021 and 2022, as the Federal Reserve prepared to hike rates in effort of stemming inflation. Some technical traders won't even bother with the reasons why, as it's the what that's so important here, and the price chart will usually display that quite well. If prices are trending and there's a reason for that trend, it may continue, and this can allow the trader to approach the market with a bias in that direction, so that if the trend does continue, they can find themselves in a good spot. But if it doesn't, they can quickly bail with the goal of loss mitigation, knowing that the trend that they were looking to continue is now in question. Of course, trends do change, and that's an obvious fact, but it's important to remember. This is where reversal strategies can come into play, and this is one of the areas where traders will often look for some type of formation to denote how they should approach that situation. This is why reversal formations can be so popular, as traders are looking for ways to get ahead of the next move at a very early stage. For the trader that's trading with a trend side bias, they'll often ignore formations that go against that bias, instead waiting for a cleaner setup that agrees with the direction of the trend. We just learned about the Morningstar formation, and there's a Morningstar formation on this chart, right at the low of the pullback in the middle of the trend, and that displays right here. Traders looking to retain a trend side bias in their approach could essentially look only for formations that agree with their directional analysis. So if a bullish uptrend is displayed, these traders can look for only formations that agree with that bullish bias. So if an evening star pattern displays in a bullish trend, rather than looking for the bearish reversal, the trader instead waits for either a bullish setup or for the market to display a reversal that can then allow them to swap their bias to bearish. This is a picture of the dollar-yen daily chart from September of 2021 into March of 2023. Notice how on the left side of the chart, as the bullish trend is starting to price in, there's a series of higher highs and higher lows that have posted in the market. This is the progression of bullish price action in the dollar-yen currency pair during the latter portion of 2021 and into and through the first half of 2022. As we discussed in the fundamental section, this is when inflation in the United States had started to grow. And while the Fed initially said that they thought it was transitory and due to supply chain effects from COVID, they began to talk about rate hikes in late 2021, eventually starting to hike rates in March of 2022. The trend in dollar-yen continued to run higher through this period. We could see the anticipation building in late 2021 and early 2022 as markets began to gear up for possible rate hikes from the Fed. This is shown in the green box on the left side of the chart. But once the Fed actually began hiking rates in March, while warning that more rate hikes were on the way, that trend got very strong, as shown in the blue box. Notice that there were pullbacks during this period, and arguably the pullbacks during a strong trending market can be relatively large, as buyers that rode the trend up look to take profits after fresh highs and evidence of a possible pullback. But the sequencing remains of higher highs and higher lows leading to that fresh high in the pair. But when prices begin to break that sequence and sets a fresh lower low, that bullish trend is now in question and possibly opening the door to a bearish downtrend, which then started to show in late 2022 trade. This then leads to a series of lower lows and lower highs as a bearish trend begins to show, and that runs all the way until bulls are able to break above the lower high, which then starts to reopen the door to bullish trend potential. These relationships are taking place in many different ways and many different forms on a number of different time frames. And this is a pretty ideal situation of trend and a trend transition as shown by price action. But again, the aim here is not to cherry pick examples. So let's look at what led to this massive bullish move in 2021 and 2022 as price was setting up in the second half of 2020 in the dollar-yen currency pair. This is the trend transition that took place in dollar-yen around the 2021 open. Again, this is the same situation that we looked at in the fundamental section during the discussion on interest rates and carry trades. But now, let's look at it from a technical point of view, utilizing price action. Coming into 2021, dollar-yen had embarked on a consistent downtrend, as noted by a series of lower lows and lower highs. Now, the low just after the 2021 open established a fresh lower low, after which price snapped back and created another point of resistance, which at the time looked to be another lower high. We have to keep in mind, we wouldn't have known that price was bottoming at the time. We'd have only known that price just made a fresh lower low and then retraced. So when prices snapped back and set that point that looks to be a lower high, the trader would still be looking for downtrend continuation. This begins to change here as price puts in a higher low. Now again, at the time, we wouldn't have known that. We'd have only known that price had reacted off of what we thought was a lower high, and that the downtrend would still be in working order. But the lower high sets a line in the sand. And after buyers push through that, we now know that the prior swing low was a higher low, and the door begins to open for bullish trends. The key change here is when price broke above the prior lower high, as indicated by the black line. That was when price went on to make a higher high, and that was coupled with the recent higher low, which we now know was a higher low. At this point, the trend has changed from bearish to bullish, as the lower lows and lower highs that dominated the market coming into 2021 have now been reversed by higher highs and higher lows in the early portion of the new year. When price begins to pull back to form a new higher low, support shows right around prior resistance, at the same black line that had previously helped to set the highs. This is a phenomenon known as support at prior resistance, and this is another reason that support or resistance levels taken from price action can be an important variable of consideration. After that higher low was confirmed as support at prior resistance, price then went on to make a fresh higher high, which was followed by another higher low, which was then followed by a strong breakout move in February and March, as there was now greater evidence of a bullish trend beginning to price in. This sparked a new trend, and this is what we had looked at just a moment ago in dollar yen with a series of higher highs and higher lows. But price action isn't always perfect. So let's look at a common pitfall that could present challenges for price action traders. We're going to look at how the last trend evolved, along with the common pitfall that can happen, especially during longer-term trend transitions. After our last trend change, we saw price put in an explosive move higher, and that lasted as price action continued to make a series of higher highs and higher lows, each marked with a blue box on this chart. But then, something else happened, as prices broke down and breached the prior higher low. I'm adding a black line to denote that higher low, and this was the higher low that printed just before the fresh higher high. But the pullback from that higher high was aggressive, eventually breaking the higher low, which we can see in that red box. Now, at this point, we have to be considering reversal potential because price has just put in a fresh lower low. And after that higher low support break, price stays down at those levels for a few days when something interesting happens, which is difficult to see on this chart, but we'll look at here in a moment. After sellers are unable to set a fresh low in that red box, price pulls back, and at this point, it appears to be a lower high. This could possibly be read as a bearish signal, as the lower low has just pulled back into a possible lower high, but when prices move down, they're unable to break below the prior lower low and instead find support at the same black line that had previously been in play as the higher low. Buyers show up over a 3-day period as indicated by the green box, and this sets a higher low, which begins to reopen the door to bullish themes, as bears have failed to continue the trend despite an open door to do so as produced by the lower low and the lower high. As prices moved down, the possibility of a bearish reversal started to look more likely, but similar to what happened in our last transition, price setting a higher low brings that bearish theme to question, as shown in the green box. Now at this point, we don't know that it's a higher low. We just know that the sell-off did not move down to create a fresh lower low. But after price breaks above the prior lower high, which is shown in the blue box as a higher high after that prior higher low, the bearish reversal theme is nullified, and the focus then moves back to bullish trends, as we have a higher high to go along with that recent higher low. Bears had an open door to produce a downtrend, as illustrated by the lower low and lower high, but the fact that they did not is notable. The takeaway here is that price action is constantly sending messages, and as traders, we have to be open to what the chart is saying, as this is market participants pricing in fundamentals and known facts, and those do change. The attraction and using formations or candlesticks to work with this constantly streaming data is in the ability to see how markets are incorporating that information, and price is non-negotiable, as prices move on the basis of supply and demand and how market participants are reacting. This is an example of a failed due trend, and it happens. And as I said at the beginning of this presentation, I wanted to look at reality. So that's why we're looking at an example of failure. Not only to notice that failure can happen, but to see what it is. And it's important for the traders to manage their risk in these situations and how they're going to respond so that when the possible lower high is broken through, the trader has little need to sit around and wait or hope. And this can be ideal for risk management. But as I said a moment ago, something interesting happened during that transition. So let's take a look. So in our last example, I said that there was something interesting that took place in the period when price was probing a fresh lower low. And this is what I was referring to. This is a zoomed in version of that higher low support break that could have potentially opened the door to bearish trends, but it did not continue. In the red box, we could see price breaking below support and setting that fresh lower low. This is where traders can start thinking of a fresh bearish trend as signaled by the lower low, at which point they can then look for the lower high. And as we looked at on the last slide, the possible lower high soon ran into a higher low, which we didn't know at the time, but was then justified by a higher high, which then pointed the trend higher. But I want to focus on one specific candle that printed during this process, which I've outlined in blue here. This is a hammer formation, which printed after bears failed to continue the support test. The candle formed as a bullish candle, but only after price had moved down for a test of the prior low. Even though sellers were able to set a fresh lower low temporarily, buyers responded in a very big way by reversing the move and then some, to the point where the daily candle closed as a gain, even after the fresh test of a lower low. Hammers are often looked at as bullish formations, and we'll discuss further on our next slide. But this candle printing after a support break and a print of a fresh low is an example of potentially conflicting signals. This will happen, and again, price action is constantly sending information to the trader as produced by actual price dynamics on the chart. So another way of thinking about this is that sellers had an open door as price broke down to a fresh lower low, but they began to show failure when buyers responded in such a big way that a hammer formation appeared. The hammer can often be followed as a sign of possible bullish reversal for exactly the reason that showed in this example. The sellers failed at a key spot on the chart. They were unable to continue a bearish trend as they were offset by buyers coming in to respond to those lower prices. Let's learn more about what goes into the hammer formation. The hammer formation is a single candle that looks almost literally like a hammer. The candle has a bullish body setting atop a wider wick, and this illustrates a possible support response. Think about it for a moment. As the candle opened, price pushes down to a low, only to bounce, erase the loss, and then finish or close near the high for that period. This could be illustrating a possible reversal, given that logic, and hammers are often approached or investigated with the aim of possible bullish scenarios, as highlighted by the intra-bar reversal that left an elongated wick to go along with a bullish candlestick body. The fact that buyers erased the prior loss to leave the candle with a net gain may be a notable observation that could potentially continue through the next bar's formation. So, in our prior example, traders were looking at the possibility of a fresh bearish trend as highlighted by a fresh lower low, at which point the hammer formation showed up. So a potentially bearish trend saw a bullish reversal candlestick, meaning that traders were dealing with conflicting signals. What should the trader do in such scenarios? Well, one option is nothing at all, until the picture clears up and matters aren't as contentious. But there may be a few different ways of approaching such scenarios, and we'll look at conflicting formations a little bit later. The takeaway from this formation is the fact that the candle literally looks like a hammer, denoted by the wide wick setting below the candle's bullish body. And this may be illustrating an intra-bar bullish reversal that could possibly continue. If price breaks below the low of the candle, the formation is negated, and bullish themes wouldn't be as attractive, as the bar would have failed to show follow-through. So this formation comes with a type of built-in risk management potential for traders that want to look to place stops below the candlestick wick, so that if the bullish trend doesn't continue, the trade could be exited with the aim of loss mitigation. The shooting star is the exact opposite of the hammer. It has a long wick atop the candle with a red body on the bottom of the bar. The candle had a test during its formation that brought sellers into the market and not only erased the entirety of the candle's gain, but sellers took over to leave a net loss during that period. The shooting star, not to be confused with the evening star, is also a show of possible bearish reversal, and the candle's logic highlights why this might be the case. The shooting star differs from the evening star, as the shooting star is only a single candlestick, while the evening star is a sequence of 3 candlesticks. But both are similarly tracked with the aim of bearish reversal potential. The hammer is often approached with bullish aim due to the failure from bears to drive after a support test. The shooting star is the exact opposite, as buyers failed to drive the breakout and sellers offset the entirety of that candle's gain to close the period in the red. In the shooting star, the item to think of is whether price is at an area on the chart that sellers may continue to defend. The fact that the wick sets a top price shows that the period had bullish activity that was rebuked, with sellers exhibiting enough control to erase the entirety of that gain and then some, to produce a red candle, signaling a loss for that period. Let's look at how these formations can be interpreted during a trending market condition. And we're once again going to draw on the dollar-yen move, this time looking at the move as the bullish trend was getting priced in during 2022 trade. At the start of the chart on the left-hand side, we have a strong bullish trend as denoted by both higher highs and higher lows. In early April, we finally get some element of a pullback, and a Morningstar formation prints inside of the green box. The 3-day sequence shows sellers on the first bar, followed by indecision on the second, and a return of bulls on the third. As we looked at previously, Morningstars are often followed with aim of bullish reversals, and that's what played out here, as there was a bullish reversal of the short-term trend, or the pullback move after fresh higher highs. And buyers coming into the matter to help solidify the bottom of the formation helped to establish a higher low. The trend continues to higher highs while making higher lows until, eventually, we get a shooting star formation printing around the prior higher high. This is shown in the red box, and as we just looked at, the shooting star is a bearish candle with wick setting atop a red candlestick body. So we can reason from this formation that bulls had initially pushed during this candle's formation, but they were rebuked by sellers as bears took control enough to erase the entirety of that prior gain. This then leads to a pullback that lasts for a couple of weeks. Sellers push price down to support, but are unable to make much ground below the prior higher low, which I've marked here with a black line. We could see the collective build of that support in the orange box, as buyers held a low for a few days. This is where we can see sellers failing to continue the move, even after the shooting star formation opened the door to a deeper pullback. The bullish trend eventually prevails as sellers were unable to continue the sell-off, and this led to a push up to higher highs. A bearish engulf prints shortly after bulls push up to a fresh high, and this leads into a pullback in the pair. The day after the bearish engulf, sellers push for a fresh low, but support shows around prior resistance, around the same level that had previously helped to produce the shooting star formation. This is yet another failure from sellers to push a fresh low, and instead, the bearish engulf has led to a support test of prior resistance. After that support inflection, a bullish engulfing formation appears, which I've noted here in the green box. This led to another push up to higher highs, but buyers weren't able to make much ground on the move higher, as another bearish engulfing formation appeared, which opened the door to another pullback. That led into a short-term bearish trend, as sellers were able to break the higher low, while driving price down for a retest of the same resistance turn support that had come into the picture before the bullish engulfing formation had appeared. At that point, bulls re-entered the equation after the test of that longer-term point of support, and that led to a hammer formation, which shows that bulls reacted to the test of lows by erasing the entirety of the prior sell-off and then some. But bulls aren't out of the woods yet, as we've just had a short-term lower low, and if sellers can hold a lower high, there is potential for a deeper pullback. Sellers are even able to hold the lower high resistance at that same spot of prior support, but they can't drive down to a fresh lower low, as buyers come in to defend the prior swing low, as shown in the blue box. That leads to bullish trend continuation, and buyers rush back into the market as the trend moves higher. Bullish engulfing formation prints in the direction of the trend, which then leads to another fresh higher high and eventually a higher low. After a prolonged bullish run, we get a bearish engulfing formation, and at the time, we have to entertain the possibility of pullback. But again, bears are unable to continue the move below prior support, keeping the bullish structure intact. And buyers drive prices to even fresher higher highs. Another bearish engulf appears at the top of this chart, and this is actually the same bearish engulf that we looked at previously, which helped to mark the top in dollar-yen in 2022 around the 150 handle. But notice, similar to the prior bearish engulf that did not continue, sellers weren't able to immediately push down to a fresh lower low, as the transition took some time as buyers showed less response to support and sellers, eventually, took greater control of the trend. The main takeaway from this chart is the power of the trend, as there are a number of formations here, both bullish and bearish. But traders would be remiss if they tried to work with any of those formations in a vacuum. As important, if not more important than the formation itself, was the context with which the formation had printed. Like the shooting star on the left side of the chart, it printed right after a fresh higher high and bullish trend continuation. So perhaps this was an area to investigate for a pullback in the move. Or for the morning star, or bullish engulfing formations that printed, which had agreement with the general bullish trend. Be powerful, because this is a bias that the market has already shown. Timing entry into trends can be difficult, and this is why risk management is such a necessity, because trends do change, and getting on the wrong side of the move could be a costly endeavor. But price action can offer traders risk-efficient ways to incorporate those trends into their approach. But as I've said numerous times here already, the aim is not to cherry pick, and what we just looked at was a very strong trend in the dollar-yen pair. Let's look at what happened before that trend ever came into the picture. And let's look at dollar-yen building ahead of the bullish trend that we just investigated. On this chart, we're looking at dollar-yen before the bullish trend that we had just examined. Trending markets can offer a possible bias to traders in the direction of that trend, and this can be helpful when reading candlestick formations. But formations can also offer setups in markets that aren't trending as decisively as what we had just looked at. If you remember from the fundamentals section, 2021 was when markets began to gear up for possible rate hikes from the Federal Reserve as U.S. inflation continued to push higher. This chart is showing the anticipation of that build, and on the left side of the screen, we can see a series of higher highs and higher lows, as noted with the blue boxes. Prices attempt a bearish reversal in April, as noted by the break of higher low support. This was the same instance we had looked at previously, on the slide entitled, When Price Action Goes Wrong. The push to a lower low opens the door for possible bearish themes, as bulls were unable to hold the prior spot of higher low support. But bears aren't able to make much ground, and a hammer formation prints after bulls come into the market as a response to lower lows. That formation led into a couple of months of strength, as prices continued to make both higher highs and higher lows. Notice how many of the highs and lows are accented with wicks on the other side of the candle, and in some cases, elongated wicks, as this is a show of response to support and or resistance as the market trends higher. In July, prices begin to pull back, showing a series of lower lows and lower highs, which we could see here accented by red boxes. But sellers were seemingly unable to continue the trend for long, similar to how bulls were stymied in July. When price goes on to set a fresh higher high in August, noted by the green box, price had just made a lower low, and then a lower high, leaving the market lacking for trend. And then for the next couple of months, we get the build of a range, as shown by the orange box. At this point, the range had built in approximately the same area that was in play in August. The market hadn't shown much for trend over this 6-month period, as prices had mostly stayed within the same space on the chart. But buyers began to show their hand in September, as noted by a strong breakout that could be seen in the blue box. Traders were able to push price beyond the range that had built in the orange box, above the prior higher high that had printed in the green box. The breakout was strong as prices pushed up to a fresh near-term high. Perhaps the more attractive setup here wasn't even the breakout, but what happened after the breakout. If we look at the prior higher high, there was a level of prior resistance that developed and was soon tested as support. I've added a red circle around that support test at prior resistance, and that's what bulls used to push a higher low into another higher high. The trend continued through Q4 2021 trade leading into 2022. That eventually led to a strong bullish breakout that we looked at on the earlier chart, but markets are not always trending, and it's important to examine how price action can be incorporated in both trending and non-trending environments. Now we're going to take another look in between the two periods that we had just examined. To recap, on the last slide, we looked at a market in a state of equilibrium before bulls showed a strong response to the Fed's rate hikes in 2022, which we had looked at previously. Bulls drove the breakout in early Q4 of 2021, and that strength led into the 2022 trade, at which point another formation appeared. On this chart, we're looking at what appeared in dollar-yen in that early 2022 scenario, when price got caught at a key spot of resistance on two separate occasions. The price of 116.34 printed in early 2022 trade and was back in the picture in mid-February to hold the highs yet again. A point of resistance, printing at the same level, opens the door for a few possible scenarios, key of which is a possible double top formation. A double top formation often coming from a level of resistance that sellers have defended, and this could develop for a number of reasons. Perhaps there's a psychological level, or a Fibonacci level, or some other point of resistance that's in the matter. The low point between the 2 points of resistance is known as the neckline, which we'll look at on the next slide. The double top is another common formation that will appear, and its opposite formation is the double bottom. The key for the formation are two highs at the same spot on the chart. The way to think of this is a level of resistance that's brought sellers into the equation. The low price between these two highs is known as the neckline, and this becomes a key point of support to watch when working with this formation. Think of this formation as resistance defense. It's essentially building because sellers responded to the same price twice, helping to hold the high at that specific level. And if their resistance defense is strong enough, it may be one of the initial steps for a reversal formation to play out. But at that point, with the high setting at the same exact price, sellers have only shown a willingness to defend resistance. They haven't yet shown the ability to take control of the trend to produce fresh lower lows, and that's what the formation will require to become workable. Sellers will need to show a willingness to push price below the neckline of the formation. So for a double top formation to trigger or activate, price needs to break below the neckline of the formation, as it illustrates bears taking a greater control of price than they did on the first instance of resistance, which helped to establish the neckline. And if the low is not broken, the formation never triggers, and the point of the double top is merely another point of resistance. This is how an ideal double top formation could play out after it triggers. The formation triggers when price breaks the neckline, or the point between the two highs that makes the double top. That then opens the door for bearish breakout potential. The breakout continues with fresh lows, after which a pullback begins to show. The pullback runs up to resistance, taken from around prior support. Is a pullback or retracement an important part of a double top formation filling in? No. But the reality is that most breakouts won't run in a straight line, and a pullback to resistance at prior support could be indicating continued development of bearish price structure with a new fresh bearish trend. Resistance showed around the same spot or prior support, bears make a notable push thereafter, as they then take control of the trend. But the start of the theme was a hold of that resistance at the same spot on the chart, establishing the double top formation. So a failure from bulls to push up to a fresh higher high and instead getting caught at the same level of resistance started to open the door to reversal potential. But the key for the double top is the break of the neckline. Because without that, all that we have is a show of defense at resistance. That could be the first step to a bearish reversal scenario, but it's not enough to trigger the formation, as the required step is that sellers are able to take control of price action. To denote that, we would need a break of the low point between the two highs to show that sellers are willing and able to drive lower lows and lower highs after the formation had appeared. Getting back to our dollar-yen example, dollar-yen continued to show strength from the breakout that appeared in October of 2021 and into the 2022 open. And at that point, the trend stalled, as showed by the two tests at 116.34, both of which were points where buyers failed to produce a breakout. This began to open the door to reversal themes, and if sellers were able to break the low point between those two highs, shown here in the blue box, known as the neckline of the formation, the door would begin to open to bearish themes under the presumption that resistance at 116.34 could be enough to hold the highs. But something else happens after that second test, as buyers come in to support a higher low in the pair. And we can see the build of that support over multiple days as bulls hold the line in the sand above the prior swing low that was shown in the first blue box. This leads to the build of another formation that we're going to look at on our next slide. The ascending triangle is another popular formation that will appear regularly on charts. The formation is noted by horizontal resistance to go along with a series of higher lows after that resistance has started to come into play. Ascending triangles are often approached with the aim of bullish breakouts, driven by the presumption that resistance is carrying less weight and the higher lows the buyers have responded to may eventually lead to a breakout beyond that resistance. Another way of thinking of this formation is the diminishing marginal impact of resistance, and we could see it playing out as a response to resistance on the first test, followed by a more moderate response to resistance on a second test, thereby allowing for a bullish trend line to connect higher lows. The formation will look like a triangle, with horizontal resistance marking the highs and higher lows produced by the trend line marking some element of support. The thought here is that each test of resistance has produced a softer response, as bulls are persistently trying to take out the highs. And if bulls can continue to force, well, then eventually there may not be any sellers left to defend that line in the sand of resistance, which could then allow for a bullish breakout to take place. As such, this formation will often be approached with the aim of bullish breakouts, looking for horizontal resistance to be broken as bulls display a greater and greater response to that resistance. On this screen, we're putting some additional context behind that double top and ascending triangle formation that showed in Q1 of 2022 in dollar yen. At the time, dollar yen had been trending higher through Q4 and into 2022, but the double top formation stalled the advance for most of January and February. At that point, traders were faced with both a possible double top formation and the ascending triangle. To trigger the double top, bears would need to push below the neckline of the formation at 113.49. And for bulls to trigger the ascending triangle, they would need to push above the horizontal resistance at 116.34. In this case, traders wouldn't even have to guess, as they could merely wait for the market to rectify the situation, which happened in March of that year as the FOMC rate decision grew closer. The breakout hit as prices broke above horizontal resistance at 116.34, and buyers continued to push a bullish move thereafter. As this happened, the double top was negated as bulls were able to force a break of the price that had previously held the two highs, as there was no trigger of the bearish reversal formation as the neckline remained unfettered. The takeaway here is the importance of trying to avoid prediction. As human beings, we can't help but be biased on a number of things. And as soon as you're long or short, you're probably already going to be biased on the matter. Because as a human being, you want to win. But the future is going to remain unpredictable because new things happen all the time, like the Fed getting really hawkish in March of 2022, which helped to build the bullish trend that we've been focusing on. Reaction, however, could be more important, as this is basing decisions off of something that's actually taken place in the market, as produced by the supply and demand of market participants responding to the same stimuli that's on our screen. Price action allows traders to try to remove as much lag from their technical analysis as possible, as it's not based on an indicator, and instead, observation of the price chart. And just like we saw in dollar yen, if there's a trend, whether it be up or down, there's probably a reason for it, and those reasons might continue. But if we see a bullish formation showing in a trend that's already shown a proclivity for bullishness, that could produce an enticing setup that the trader can look to incorporate into their approach. But this case of conflicting formations is something that will pop up from time to time. I wanted to finish our price action discussion with this example for a couple of different reasons. First, to highlight that price action is not predictive, just like any other form of chart or technical analysis is not predictive. But perhaps more importantly, traders don't need to expect price action to be predictive. It's merely observing the dynamics of the present. Buyers defending support could be notable, or sellers defending resistance could lead into reversal setups or formations. Formations can be helpful as they highlight behaviors that are showing in the market, which may be read as some type of indication of what could possibly happen. There will be times where there are conflicting formations, and there will be times where even a perfectly framed formation doesn't work out. This is why we started the course with the math of gains and losses, because risk management is of significant importance for any strategy, whether it's price action or anything else. The benefit of price action is that it's focusing on the same variable that's triggering stops or driving to take profit orders. As we talked about in technical indicators, lag is inherent with any indicator that we use because of the periods that go into its calculation. With price action, we're going right to the source, price itself. Since price action is subjective, there will be situations where there are both a bullish and a bearish indication. In this case, the trader has a few options for approaching the situation. The first and most obvious is to wait, take a step back, and let the noise of the conflicting formations rectify itself before drawing expectations for what might happen next. But there's also the option to institute a bias in the direction of the trend or in the direction that you want to trade the market. And this then provides some element of context so that you know if or when your choice of which formation to follow has been invalidated. And thusly, this can help you to manage the risk. So if we go back to our dollar yen scenario, where there were two conflicting formations, we had a double top that was potentially bearish, if or when the neckline was broken. And we also had an ascending triangle, produced by the horizontal resistance and the build of higher lows. Traders have a couple of options for proceeding. If they choose to wait and avoid taking a setup when there's conflicting formations, they could simply let the market rectify the situation. If price goes down and breaks the low from the double top, the bearish formation would trigger. And this would bring question to the trend, given that the bullish trend is now seeing lower lows. This would open the door for bearish trend continuation potential. Conversely, if the resistance level from the ascending triangle is broken, this can open the door for bullish trend resumption, as we would have seen a bullish breakout from the formation in the direction of the prior bullish trend. It is completely possible, however, that we get a false breakout at resistance followed by a sell-off that breaks the double top but does not continue. This would mean that both formations would have presented some element of failure to the trader, and this is one of the reasons that many will choose the first option when dealing with conflicting formations. And that's to simply wait, be patient, and see which direction the market moves, at which point the price action trader can then react. The trader that was waiting and patient Even in the adverse scenario, where both formations initially failed, the patient trader could have simply allowed for the breakout or the breakdown to take place, after which they can then aim to trade the new trend in whichever direction it wants to go. While the trader may give up some possible upside in waiting and allowing the move to begin to develop before taking on risk, it can also be very helpful for clarity in the mind of the trader. This is something that we'll discuss in depth in our last section on trading psychology. Thank you for joining me, and I look forward to seeing you in our next discussion on trading strategy and market conditions.